All right, so let's jump right into things. Hello, everyone. Thank you so much for taking some time out of your day today to join us here on our webinar. My name is Jonathan Brandao, and I am here with MLB Wholesale. And what we're going to be talking about today is our buy before you sell programs. Now, of course, you saw is part of our registration of today's particular webinar. We kind of focused mainly there on the MLB Step Forward program, which is where we're going to kind of really spend some time on there. But I thought it would be great as well, since we're talking about the Step Forward, to also throw in a little bit of information about the knock program as well, because both of these programs are both considered your buy before you sell programs. They're the programs for those borrowers looking for an opportunity to remove a departing home from their DTI, to get that a little extra assistance, in some cases, a bridge loan, to move between their departing residence and the new home that they're purchasing. So what I'll do is I'll use this opportunity to highlight the MLB Step Forward, of course, but also the knock bridge loan option. So that way you can see that we have two different options available that vary. They have some similarities, but there's also some big differences between the two as well. So that way you know, and once again, have these opportunities in your back pocket if you have a borrower that fits within these types of scenarios. Now, what we do all the time with these presentations, if you have any questions, feel free to put those questions into the chat box that's here in Zoom. If I don't answer those questions right away, we'll circle back around to them as we go through, or at least we will get to them at the end of the presentation where we'll circle back through and make sure we cover anything we might have missed. We also give a few minutes at the end too to open it up. So if you want to save questions for the end, you're more than welcome to do that as well, and we can kind of have a free kind of open conversation about any questions you may have when we get to that point as well. So let's jump right into things and talk about these buy before you sell programs. So first off, kind of starting off the basics here. So there's a catch 22 that most borrowers out there are going to be facing. Certain things that may come across that may get in the way and put them into limbo when they're going ahead and purchasing a brand new home. And one of those big things is, of course, your home sale contingency, that they have to sell their existing home in order to be able to afford and move into the new home that they want to purchase. And that's where these buy before you sell programs come into place. So these are the things that come up. So buyers need equity. They can't buy until they sell their existing home. They are losing offers because there are borrowers out there who are able to provide non-contingent offers to these homes that they want to purchase. And of course, just the general stress, the double moves, the timing between the two are just additional risks and stress, as I mentioned, on those borrowers. But these types of programs remove that friction from the transaction. So what is a buy before you sell? Or you'll see BBYS. So you'll see that abbreviation a lot through this presentation. And what it is just as the name entails, it allows them to buy first and then sell their existing home later, removing that home sale contingency, and at the end of the day, providing that peace of mind that if something doesn't sell, if that existing home doesn't sell on the market, that there is a option that's going to come in and purchase that home from them. So whether that be the Step Forward or the knock program, one of those is going to purchase that existing home, that departing home, if it doesn't sell on the open market, as well. So having that backup option there with a peace of mind. So let's talk about this. So there's two different programs. So there's two different solutions, but at the end of the day, we have that same goal. And like I mentioned, you have the MLB Step Forward, and then you have the knock bridge loan. At the end of the day, let's talk about the core product, who funds it, and then the backup buyer and what the final goal is. So at the core, the MLB Step Forward has built into it the guaranteed backup offer. So that's a binding contract between the borrower and Calc. So you'll see right there, backup buyer, Calc. Calc is the one who is uh, presenting this binding contract between themselves and the borrower, that if that home does not sell within 180 days on the open market, they will purchase that home from the borrower. And that's done through that guaranteed backup offer or GBO. Now, when it comes to knock, Knock is done as a bridge loan. So there is an additional lien being open and done as your traditional bridge loan standpoint if you're going with knock. So that's kind of the difference there. Now, who funds Step Forward? MLB will be the one who funds the new purchase. So the brand new home that they're purchasing, MLB will be the one handling that. Anything else is handled 100% by calc. So that's between you as the loan officer, the buyer or borrower, and calc. So you working together with calc to handle anything that's in relation to the departing residents. The home that they're purchasing is all going to be done through MLB. And then you have knock, where knock, because it is a traditional bridge loan and they're opening up a second lien, knock is going to be funding that bridge loan. So they're going to be funding that additional lien, that bridge loan, if you're going with the knock option. We talked about those buyers. Once again, Step Forward is being run and powered by Calc, and knock is being run by knock. That's the name of the company. But at the end of the day, both companies, their primary goal is to ensure that the departing residence is sold on the open market. Both Calc and Knock do not want to purchase these homes from the buyer or the borrower. They want that borrower to be able to sell it on the traditional open market. So that's why they give that 180 days for on the open market before they step in. If for some reason you get to day 181 and that home has still not sold on the open market, they'll step in and purchase that departing residence from the borrower. And depending on what option the borrower went with, will depend on how much the borrower gets as part of that sale if Calc or Knock needs to step in to purchase the home. So since we kind of primarily right now are talking about the MLB Step Forward, let's start with that and kind of talk out the specifics here. So you have your guaranteed backup offer, or GBO, as I mentioned. It's exactly that. It's a binding backup purchase agreement. So Calc, they are not a lender, so they do not fund or originate mortgages themselves. They strictly act as a backup buyer in case that home does not sell on the open market within 180 days. So it allows everybody as part of the transaction the ability to understand within 180 days, just get that home sold on the open market. Now, if Calc needs to step in, they'll do so from there. Borrower lists and sells on the open market, traditional same way as they would with any other transaction. And then if for some reason, if Calc does need to step in and purchase that home after 180 days, if the home sells for more than what they purchased it for, the net profit actually still goes back to the borrower. So the borrower does not lose out in the long run if Calc ends up selling the home for more than what they purchased it from the borrower as well. After, of course, all your standard selling expenses. So Calc will take out the expenses for the selling, but otherwise, if there is more funds in there, that will go back to the borrower still. Um, the great thing here is that we want to make sure, keep this sure about Calc, is that for either of the options that Calc offers, so they actually offer two different options, which we're going to talk about in a moment. For either of those options, the homeowner needs at least a minimum of 30% of equity in the home in order to ensure that all the Calc offers actually cover the liens in the case that Calc needs to step in and purchase the property. So that's a big thing to keep in mind there, is that when you're speaking with a borrower and seeing how much they owe on the home that they're leaving, they need to have at least a minimum of 30% of equity in the home at the time when they're looking to move forward with the Step Forward program. Um, so that includes the equity the borrower pulls from the down payment towards the new home that they're purchasing as well. So you want to make sure we have that minimum equity amount. So first one here we want to talk about is the trade-in mortgage. So this is the first option that MLB Step Forward offers. So what this does is that this one, similar to like knock, which we'll talk about in a few slides, um, is actually a second lien that is used to access equity. So this is the case for your borrowers that need equity in order to pull funds for their down payment, for debt payoff, or any other type of approved needs towards the brand new house that they're purchasing. Um, in this case, in both cases, the departing home and second lien are removed from the DTI. So that is still not included in the DTI on the brand new home that they're purchasing. That's kind of the plus of using a buy before you sell program is the whole point is removing these amounts from the DTI, but it'll still be removed there. But once again, trade-in mortgage is going to be based on that. Now, big piece we want to call out there is kind of up there in small print at the top of this slide is that the backup offer that will be given to that borrower to purchase the home, if Calc needs to purchase the home, remember, if Calc will make a offer up to 70% of the current value of that home. So that's a big thing to keep in mind there. So it's not 100% of the value of the home, 90%, it's 70% of the value of that home is what Calc's going to give in that backup offer. Once again, the program is designed to make sure this home is sold on the open market and that Calc doesn't have to purchase the home. But if they do, they're going to the borrower will get 70% of their home value from that offer. The other option here is the contingency buster. These are for your borrowers that have more liquidity, and they do not need equity in order to move into the new home. So it still removes the departing residents from the DTI. Like I said, there's no equity access. There's lower fees and a faster turnaround time for the offer from Calc. And it's mainly structured for your strong liquidity borrowers. Now, the offer that Calc gives on your contingency buster is all based on how much of the total mortgage slash lien is owed on that departing residence at the time of when that offer is there. Once again, big piece here. Sorry, I kind of skipped ahead there. Biggest thing here is making sure, once again, they have that at least minimum of 30% of equity in the home in order for them to move forward. The offer that Calc makes is based on the amount owed against all in the property on total liens. So that includes mortgages, judgments, any UCC filings, for example. So, for example, if the home value is $600,000 and they have a total lien of $300,000, then the amount that will be offered to the borrower is $300,000. So that's the contingency buster example for you to keep track of that. Now, I saw a question come in, what's the minimum sales price? So there isn't a minimum sales price, but there is a maximum. So maximum is 1.5 million. If they do need that equity in the property with the trade-in mortgage, that is done through Calc, but also through a third party called Figure to open up that second lien. If they do need that, there are some additional restrictions. So minimum FICO is a 640 in that case, max DTI 50%. There are some additional origination fees, max CLTV is 85%. So the loan amounts need to be a minimum of 15,000 in this case. So in this case, in the case of the second lien there, minimum of 15,000 loan amount with a maximum of 750K. The only difference there is if you do business in the state of Texas. In Texas, there is a minimum loan amount of 35,000. And then mobile manufactured homes are ineligible. So this is just something additional. If they do need that second lien for equity in the Step Forward program, they would need to follow these additional guidelines as well. So that is the step forward, and we'll touch back and forth on that a little bit more too. But like I mentioned, because we're talking about step forward, why not talk about the other buy before you sell program as well? So good question. Somebody asked, are condos okay? The answer is no. So condominiums are not allowed on either program, either step forward or knock. Condominiums are not allowed. For the knock bridge loan, so that's the other buy before you sell program we have. That one has a 620 minimum FICO. This one can cover up to 6 months of payments at zero interest. That's a piece there that we haven't touched on with Step Forward. Step Forward does not cover payments on the departing residence. So the borrower is still responsible for making payments on their departing residence and the brand new home that they're purchasing. the either of those step forward programs do not cover those mortgage payments. But the bridge loan, because it is a bridge loan, can cover up to 6 months of those payments. Um, Equity can be used up to fund up to 50% of the down payment. Its knock allows up to $1 million. And just like the step forward, it removes that home sale contingency when they go ahead and make offers. So, biggest thing here, why most people love it is that there's certainty with it. It's convenient because not only those options we talked about already, but knock actually provides up to $35,000 in home prep funds that can go to those borrowers, and even up to $5,000 for moving costs. They can tap into equity without having to refinance on the existing home. They can use that equity to go ahead and move into the brand new home that they're purchasing, and gives them more of a competitive edge on those offers to get the home that they really, really want to purchase. And of course, there's no cost to you. There's no additional cost to any of your real estate agents, and there's no cost to you as a mortgage broker or correspondent lender. There's no additional items in that case when it comes to that piece of it. Now, speaking about those funds, we talked about that. So let's talk about equity access first. They can do equity access on step forward if they go with the trade-in mortgage option with that optional second lien. The equity access is always going to be there on the knock because the knock is always going to be a built-in bridge loan. Can you get down payment help on either? Yes, the answer is yes. You can in both case. Step forward would be if you got that second lien. Knock, it automatically comes with that. Home prep and moving. Step Forward has limited kind of options there, but the knock program is always going to provide those additional funds to help those borrowers with home prep and moving. And then that PITI coverage, like I mentioned, Step Forward has no coverage when it comes to covering any departing residents' payments, but knock can go up to 6 months of covering those departing residents' mortgage payments. Overall, the speed and simplicity of either program kind of depends on it. Now, with your step forward, you can get an offer from Calc within 1 to 9 business days, depending on which option you're using. The trade-in mortgage is more on the longer side of getting an offer, whereas if you're doing the contingency buster, those are usually 1 to 2 business days because those are your more liquidity borrowers. Knock gives a pre-approval within 24 to 48 hours on their bridge loan. Doc's complexity, step forward is a very low amount of complexity for documents because all you're doing is just, if you're doing the additional lien, that's probably the more complicated side of things because you need those additional documents for an additional lien. But if you're doing contingency buster, for example, there are no additional documents or hoops that people need to go through really for that, other than just verifying the details with Calc directly, and filling out those forms and agreeing to the contract when it comes to that. Um, for knock, because it is a second lien property, that one's going to have a much higher complexity of documents because you're going to go through and fill out a lot more things. And the great thing is of course, as I'm talking about these programs, all this stuff is going to be, you're going to get assistance from the MLB team here to help you go through all of these things and go through this process. You don't need to worry about going through a third party website or portal or anything like that. It's all done directly as you're working with us. But you're also going to be working with a representative at either company with program you did. So you as the loan officer and your borrower, you're going to be communicating directly with a representative at Calc or a representative at Knock who will be there with you from A to Z to help you with answer any questions in relation to their side of things, what's required, all those additional pieces as well. From a fee standpoint, Step Forward has a $2,000 flat fee plus 1% of the offer that they give. That fee is not collected until the loan has closed. So once we've actually closed on the purchase loan here at MLB, and once the departing residence has sold, I should say, once the departing residence has sold, then that fee will be collected from the sales proceeds. So the borrower is not paying this out of pocket up front. They're not paying it in the middle. They're paying it once the original home has sold on the open market. Now with the knock, there's going to be a fee of 2.25%. Plus, there will be some closing cost fees, and that stuff will vary, of course, on a loan by loan basis. And then, as I mentioned, there are no additional interest on the step forward because they're not covering any type of payments or anything like that. But knock, because they can cover up to 6 months of payments, it is going to be a 0% interest rate. So there's no additional interest rate on that. It will just show as zero. So the real question here is which program is going to work with your buyer? Which program is the best fit for your borrower? Is it going to be the MLB step forward? So those are borrowers that have strong liquidity. They have minimal cash needs, something that's a lot more simple of a scenario, and they want a faster approval. They want a faster process. That's where you can go ahead and use the step forward. With the knock bridge loan program, let's say those are borrowers that need additional cash for down payment, for help for their departing residents' mortgage payments. They need help with the prep of moving into a new home. They have tighter DTIs, higher equity in the property, and they're working in competitive markets where it is much more difficult to get a good offer on a home without removing that home sale contingency. That's where knock might be the better fit for your borrower. So it's all dependent on kind of how you go from there. Now, a question came in is, are we required to include the leave behind PITI when using the knock product? So the great thing is that knock still, even with that, will still remove that from your DTI. So you'll still be able to remove the departing residence payments from your DTI on the new home purchase as well. So at the end of the day, the biggest part about your buy before you sell programs is that it removes your contingencies. It allows you to have much stronger purchase offers when you're going out there in your competitive markets. There's a higher close rate just because you're able to move from there. You're taking your borrowers that maybe almost qualified for something and allows them an opportunity to move forward for what works from there. And at the end of the day, it's something different that you can present to your realtor partners that may be a good fit for them. Now, the thing about this program and a lot of these programs that we speak about here, not just the ones we're talking about today, is that I like to call these your back pocket programs. We officially call them, of course, your making lives better programs. Your programs that are designed to help your borrowers that a lot of times people have said no to them, and we want to have opportunities to say yes. And I call them back pocket programs too because they're not going to fit for every borrower. They're not going to fit with maybe every borrower you see in a week. But one day you'll have that borrower come across your desk and have a conversation with, and you go, oh, wait a minute. There's that program with MLB that fits perfectly. It has checks all the boxes that this is probably going to be the best option for them to move forward with. These are great conversation starters for having a conversation with your realtor partners, and your borrowers to see, okay, is this something that's going to work out and kind of start that conversation? And maybe it doesn't go in the direction where you end up using one of these, and that's perfectly okay. But it once again makes you different out there saying, oh, I have this in my back pocket. I have this as an opportunity that we can use if we need it. Like if we need it, then we can use it. And that's what's so fantastic about these buy before you sell programs and a lot of these other making life better programs that we offer here at MLB. Some frequently asked questions I want to bring up here. First one, this page is just strictly about the step forward. One of the most common questions, and something we actually haven't touched on, is whether Calc wants to buy your home or not. And the answer is no. Calc is not in the business of purchasing homes from borrowers. They want that home to sell on the open market. Now, historically, Calc has existed for about 6 to 7 years now as an organization. They have purchased less than 2% of homes in that time. And in 2024 and 2025, they purchased zero homes. So of all the borrowers they assisted in the last 2 years, none of those homes were purchased by Calc. They all sold on the open market within that 180-day time frame. So that's kind of a great way to look at it there is that, yes, if they have to buy the home, they're only going to give the borrower 70% of their value, but they haven't had to buy a home for the last 2 years from any of the transactions they've worked on. So that kind of shows kind of how it works and how the program has been successful for a lot of people. Like I mentioned, once they sign that offer, the borrower has 180 days to sell in the open market. MLB will be the one who originates and kind of works with you on the new home, and we're the ones that will underwrite it, we'll fund it, we'll do all everything we need to do from there, based on your relationship with it. If equity is needed, both the Step Forward and Knock has the option there for that second lien for equity. Calc themselves does not fund loans. So Calc is not a lender. They do not have the ability, nor, from what I understand, the inspiration to go ahead and ever originate or fund loans. That's all done by MLB in this case. Is there a cost if the home sells for more? So no, if the home sells on the open market for more than what the offer was from Calc, the fees do not increase. So there's still that flat $2,000 fee, and then that percentage based on what the offer was from Calc. That's it. The borrower doesn't need to worry about getting charged more just because their home sold more on the open market. Can equity be used towards down payment? Yes, if they do the trade-in option, they can do that. And then, as we mentioned a few times, the borrower is responsible for making mortgage payments on their departing residents. Those funds are not escrowed when it comes to the Step Forward program specifically. All right. So moving over to some frequently asked questions about Knock. Same thing as Calc. Knock is not interested in buying homes from borrowers. They want those homes to sell in the open market. And from that case, Knock actually, it says Calc here, but that's a mistake there. I'll update that. But right here, so it's the same kind of message there, is that Knock actually has purchased less than 1% of homes through their bridge loans in the last few years. So that's really a great thing as well. So they really haven't had to need to jump in and purchase homes from the homes that they've worked with. How long does the borrower have to sell their home? They have 6 months to sell their departing residence on the open market before the backup option is available. Knock in this case, because it is always going to be a second lien with Knock, Knock handles all the bridge loan disclosures. They wire the bridge funds directly to the settlement agent on the day of purchase. And then MLB will handle everything in relation to the purchase transaction. How fast is Knock? How long is the process for a Knock bridge loan? Pre-approvals are done in usually 24 to 48 hours once they get all the required documentation. Closings can occur in few as 12 business days after the Knock sign disclosures are completed. So once we have all those disclosures, this is a process that can take your traditional, I would say 30 days, as some people like to say, or you could do less than that if we have everything we need as we go. Excuse me. And big thing here we want to call out is that can this loan be FHA? No. So the purchase loan must be conventional or non-QM. So the new house that they're purchasing has to be either a conventional loan or non-QM. That applies across the board for all of your buy before you sell. So your buy before you sell programs, both the Step Forward and the Knock, cannot go FHA, USDA, VA, cannot go government. You have to go either conventional or non-QM. I do want to pull this up for your own resources here. These slides I'm using today are currently available on our website. I actually provided a link a little bit at the top of our chat here that you can use that has all of our videos and presentations that will give you the information about all of our programs plus the presentation here. So you can click on these links. The first thing I have up here is your Calc resources for your Step Forward. You can scan the QR code I have up here on the screen, or you can go into our page there and download the deck and click on the links I have here. You can actually book a one-on-one training with the Calc team. They'll walk you through the entire process from A to Z, answer any questions you have, any questions or concerns about the process, how they work, all of that. They are fantastic when it comes to explaining all this. They are so much more, um, uh, they can provide so much more enlightenment and details than our team can about how they work on their inner workings there. And then once you're ready to go ahead and move forward with the MLB Step Forward program, you do need to go ahead and submit the application for the borrower and their property. So that will be done through Calc's website right there. And of course, on their website, they have their property eligibility guidelines that breaks down exactly what they can and cannot accept on a property by property basis. Same thing applies to Knock. So this next slide, same thing. QR code brings you directly to Knock's information. You can reach out and contact the Knock team directly. And once again, they can schedule one-on-one trainings with you, break those down. The great thing is that these teams, especially the Calc team for Step Forward, they also offer lunch and learns with realtors where you can actually schedule a meeting where a Calc team member will either arrive in person, depending on where you are located, or they'll schedule a virtual where they will actually pay up to $500 towards a lunch and learn class, all about the MLB Step Forward program. So you can reach out to them and they'll be more than happy to set up those calls with that. The Knock team will be happy to walk you through, give you additional training materials, explanation. Once again, questions and concerns you could direct right to them and they'll be happy to answer those. And same thing, when you're ready to go, submit your application directly through Knock. That's the first step you're going to do for both Step Forward and Knock. They do require that you submit applications through their websites to get that borrower's departing residence into the system, and they can start that process of putting together that binding contract for the offer to purchase the home if they need to purchase the home after those particular days. And of course, you can review their FAQs there from their website as well. So that's the Knock resources here on the page. Feel free to scan those codes there. I'll pop up here for a second. Go back. Here's the Calc one again for Step Forward if you need it. But like I mentioned, these slides I'm showing you are currently available on our website. I provided the link a little bit earlier in the chat as well. Of course, if you need any additional assistance when it comes to MLB side of things, your assigned account executive is always going to be your first person to reach out to with any questions that you may have about any of these programs that I talked about today, plus lots of the other exciting things we have to offer here at MLB. Our AE here on our team will be able to help identify what program works the best for you and what we're able to offer there and how we can present these to the partners that you're working with. So in those cases, if you have any additional questions that I may be able to answer for you today, feel free to throw those into the chat box here, or you feel free to unmute yourself as well, raise your hand, and I'll be happy to stick around for a few minutes and answer those to the best of my ability. I did see one question come in here I want to jump around to, but let's see here. So I had a question come in that said, I have clients who will need equity from existing to put down on their home they intend to purchase. They will also need to not have their departing residence included in their DTI. They are a retired couple. Between Knock and Step Forward, which would be the better option for them? So that would all depend on a couple different factors. So, of course, depending on how much equity they have in their departing residence. So, for Step Forward, they need at least a minimum of 30% of equity in their home. So, if they have that minimum of 30% equity, then Step Forward will probably be their best option there. The Knock program will remove the departing residents from their DTI either way. So no matter what will be in that case. But depending on how much they need, the trade-in for Step Forward may be the best fit for them. But you can kind of take a look at those different pieces for there. There's little pieces that may be different depending on more factors of your borrowers. But I'm leaning towards Step Forward right now. But I would recommend looking into a little bit more. Talk to your account executive. like I mentioned, you can even reach out to these the different contacts at these companies, run your scenario by them, and they'll be able to give you kind of a clear picture of, okay, how does this work with us? And that'd be a great opportunity too. Thank you for that question. All right. So great thing is here too, the recording of today's webinar, these webinars, we record them. We actually post them to our YouTube channel. So if you just go to MLB Wholesale on YouTube, that's where we post these recordings once our team has gone ahead and reviewed everything and make sure everything looks good to be posted. So keep an eye out on there, and we'll be able to get those. And of course, reach out to your AE. And if you kind of remember about it, you'll be able to your AE will be able to point in the direction of where that is as well. So a question came in here. Let's see here. Will the borrower be charged if the property is sold less than the price after 6 months? So are not. So the borrower is not penalized. In either option. So at the end of the day, no matter how much the home sells for on the open market, the borrower's still going to be getting the same fees. So the same fees are going to be charged to them. So, like for example, the step forward has that 2%, not 2%, 2000. Let me actually bring it up here so actually you guys can see it. So you have, for example, here the step forward has that $2,000 flat fee plus 1% of the offer, and then knock has that 2.25% of the offer fee plus closing costs. No matter what the home sells for, either up or down, it's going to be the same fee. So the borrower's not penalized in either way and not asked to any additional funds on top of that. Awesome. All right. So, unless you guys have any other questions, like I said, if you think of something else, reach out to your account executive. Let us know how we can assist you and kind of navigate through these programs. And of course, all the other awesome programs we have here at MLB. I have here on the screen that's our client services team as well, who will be there to help you with your active loans once you have a loan fully registered and moving through the system from that case. So, it's a great opportunity for you to go from there. Somebody had a question here. Actually, I want to throw this in here. Somebody asked a question: would this be good to solicit listing on the market for over 90 days? Um, it could work in that case. That is a possible good opportunity there. If you have something that is been listed for a certain amount of time. Now, keep in mind is that the longer it's been listed prior to our application, there may be some additional restrictions that Calc or Knock puts on if they will or will not accept that home. So if the home's already been listed for a while, they may put some additional restrictions on there. That's something that they'll be able to provide some further clarification on a kind of case by case basis. John, you had a question?
Yeah, Jonathan. Just to follow up with that, I was actually just on the phone with Elisa, the rep from Knock. They will not take a house that's been on the market 75 days or longer. It has to be pulled off market and sit for 90 days for a reset period. What he said was the once the house goes on the market, it starts losing value. So the shorter it's been on the market, the better. But if you're getting closer to 75 days, you're running out of time. And once you pass 75 days, they'll ask you to pull it off the market and sit 90 days to reset the clock.
Mhm.
And then my question is looking over these programs and looking over not, because I've been out pushing this pretty heavily and talking with my agents about it. What kind of rates do they get on the loan once they buy the new home? What are the rates in that realm of the loan they're actually going to be paying on eventually?
So for the purchase home, it's going to be your traditional. conventional rates. Now, I can't speak to like the exact numbers, like I personally,
Okay.
but your account executive would be able to give you the exact numbers on that, and of course our pricing engine. But it's not going to be like a separate um, price. It's not going to be like a higher rate or anything like that. It's going to be your traditional. Like I mentioned, the purchase loan can only be conventional or non-QM, so it's whatever our current traditional conventional or non-QM rates are going to be.
Okay, gotcha. And then they're only qualifying, I mean, for knock, it was a 620 credit score, and the more equity, the better in the home was literally the qualification, and that the
Correct.
subject property that they want to sell qualifies. So seemed like a pretty simple get in and go.
Yeah, it's pretty straightforward for like if you have somebody that fits within all the right buckets.
Okay, cool.
Of
Thank
course.
you.
So, there's a question about LTVs and CLTVs on knock. So, in Knock's case, those are the specifics that I might have to get some further clarification for you. But like I said, for the for the new home that they're purchasing, they're just going off of your traditional kind of conventional and non-QM products. So there's no additional restrictions on the new home that they're purchasing. It's what you're used to on Fannie Mae, Freddie Mac, for example, for that. Now for step forward, if if you do need that additional money for equity, step forward has that max CLTV at 85%. So that's kind of the difference for that one. We do have flyers on our website. If you go to MLBwholesale.com, there are flyers there. You can see which ones we currently have available. And if you reach out to your account executive, they can actually work with our marketing team to get updated versions of those flyers with your personal contact information on them. So that way you're able to go ahead and um, that way able to go ahead and have those materials to go out there and promote with all the correct information listed. All right. All right. Thank you so much. There was some awesome questions in there. Like I said, our team is here to help you guys out. Whenever you have any questions, reach out. I know John mentioned he spoke to one of our contacts there at Knock. Uh, Olisa over there is awesome. He's our primary contact there. We have a whole team there at Calc that is dedicated to help out our partners at MLB. So you can reach out to them, and like I said, they can do one-on-one trainings, lunch and learns, all that type of fun stuff to really help you get a full grasp on how you can market this and work for the best for the borrowers that you're serving within your communities. All right. Thank you all so much for taking some time out of your day. I hope you all have a wonderful rest of your week. Thank you so much for being partners with MLB and of course helping us on our mission of continuing to make lives better. Thank you all so much and have a wonderful rest of your day.